Hello everyone, welcome back. My name is Mayur Thaker. I am an analyst and co-portfolio manager of the Zacks earnings certain family of portfolios. And this is a bi-weekly update on several economic data points that I am keeping tabs on. So let's get started with that. So the first, thing that I wanted to just, bring to your attention is we're interestingly at a valuation right now. If you look at this chart, this is an overlay of the S&P 500's forward PE versus the Fed funds rate. And you can kind of see how those two look, superimposed on each other. And right now we're at a Fed funds rate that we haven't seen really since the mid 2000s. You can go all the way back to 2005, and you can see the last time that we were this high on the Fed funds rate. And interestingly, valuations, which makes sense, were much lower than where we are right now. The market currently trades at 18 times forward earnings, and those forward earnings are, being marked down, almost every week is what we're noticing here. So as we get more companies report earnings at this point, we have essentially, concluded Q4 earnings. We're not getting, updates from other bellwethers like NVIDIA and Walmart since they have an off reporting cycle. But overall, earnings estimates continue to be marched lower. And at the same time, the market trades at 18 times forward earnings. The last time we had a Fed funds rate at roughly 5%, we were at multiples much lower. You can see here it was at roughly 14 or 15 times. So from the get-go there, we can see that, currently valuations are higher than where they normally are, during a increasing rate environment, especially at the level that we're at right now, between 4 to 5%. And as we heard from the press conference from Jay Powell a couple of weeks ago, rates are most likely going higher. It's almost a 100% certainty that we will get at least two more increases of 25 basis points. And it's possible, in my view, that we could get even more than that. We'll take a look at a few of those charts here. So, markets right now seem to be defying what the Fed is currently doing and is trying to do with regards to interest rates and its relationships to asset valuations. You can also see, that, PE multiples are not just a function of, you can say, well, Mayur, PE multiples are not just a function of interest rates, they're also a function of growth. And you can see here on this chart that, growth has rolled over. And we're now, expected to have a decline year over year of about 2.8%. So I've overlaid the forward 12-month forecast of earnings on a year-over-year growth basis. And you can see that right now, over the next 4 quarters, earnings are expected to be down 2.8% over the prior 4 quarters. So that's much lower than where we were the last time we had a 5%, Fed funds rate. We were at a much healthier range of somewhere between, let's just say, 6% to about 15% earnings growth for a couple of years here between 2004 to 2007. So earnings are clearly being marched down. You can see as we, got more and more earnings reports from companies in Q4, this past couple of weeks here. Analysts have continued to slash estimates, and you can see all the bellwethers have guided lower. Google, has reported a slowdown in ad revenue. Microsoft has reported a slowdown in their Azure cloud services division, which is, the division that, typically sees 20 to 30% growth. They've marked that down to about 15%, and it could be even lower as the year progresses. So there's, obviously a very clear and distinct, re-rating of earnings. But for some reason, valuations have not yet reflected that. So we'll see if that, changes. We know that, the Fed, in addition to increasing interest rates, they are also committed to tapering the balance sheet, which affects liquidity. And here you can see a measurement of liquidity, which is the M2 money supply. This is the total amount of money that, resides in the hands of, depository institutions, ultimately in the hands of the people, everyday people. And you can see that in response to COVID, we had, the greatest monetary experiment in history, where, M2 soared, roughly, what was that? About 20% year over year, actually almost up to 27% year over year, which has never been experimented before in the past. You can see that the biggest jump in money supply ever was in the late 70s, and that was roughly 12.9, about 13% or so. You can see that there, and this was, a clear step above that. So you can see that M2 grew far above trend growth in response to the COVID pandemic here. And now the Fed is finally committed to reversing that trend. And so you can see that M2 for the first time in US history has now gone negative on a year-over-year basis. And there's still a lot more to go to the downside if we were to just simply return to trend growth. So, I think that this number is going to go deeper negative, as the year progresses. And that's going to weigh on asset valuations. Remember, liquidity is a huge driver of PE multiples, as well as just valuations of assets across the board, housing, used cars, other assets, other real assets, as well as other financial assets. So as the Fed increases interest rates further, which I believe they will, multiple times, as they have said, and as the Fed tapers the balance sheet and, M2 contracts, I think that this, poses a real risk for equity valuations. You can see that certain economic indicators like the Treasury yield curve, this is the spread between the 10-year yield minus the 2-year yield. This has had a tremendous track record at predicting recessions, for example. And once again, we're deeply inverted, the most in roughly 50 years. This is telegraphing a contraction in the economy. The backlog, right? When you look at the backlog, this is a chart that I've, shown since last year, roughly almost a year from now is when I first started showing this relationship to everyone. Backlog is down significantly. And backlog can come down either through supply or production gains or through demand destruction. And we can see that very clearly it's not production that's increasing. So the only way backlog could come down without production going up is if demand has eased significantly. And that's exactly what has happened. And so backlog is down, and I believe that the CPI will follow as it, already has started to show. So you can see that the backlog hit a high, really a 50-year high, way back in the summer of 2021. It has, eased quite significantly and is now clearly in contraction. And now you can see the CPI is following suit here. This operates at roughly a 6-month lag here. So you can see that happening now. So I very, clearly believe that the CPI is going to come down. It will get down to the 2% target that the Fed wants. But it's not going to come without pain because there's a reason for this happening, which is demand destruction, in my view. And you can break down the CPI and see that, a big contributing factor of the CPI to the upside was energy and food prices, which is the more, volatile part of the CPI because those are commodities driven. And commodities are obviously traded on a daily basis. But you can see that, core CPI is also easing here. So fundamentally from, the side of the economy in which is not directly related to volatile commodities prices, you can see that the core CPI is coming in lower as well. And it's still lower than the headline number overall. So this number will start to come down. It already broke this little trough right here that we saw in the summer of 2022. And I believe the next stop is, under 5%, and that should be happening, sometime this year. Again, new orders index. This is another measurement of demand. Remember, I was trying to explain that the backlog is coming down not because, production is, surging, but because demand is in contraction. You can see that the new orders index, which is a great measurement of aggregate demand, continues to be in deep contraction mode and pretty much at the lowest readings that we have seen since 2008. If you were to just ignore the COVID pandemic, these numbers are not looking good overall. You can see that housing is starting to show signs of slowing here, and very, very obviously because, the 30-year fixed rate, mortgage rate has, soared, almost to 7%. You can see that's very clearly beyond 6% here. Just 2 years ago, we were at 3%. And, I was lucky enough to just have, dumb luck. And, I timed it, such that, I bought my house at 3%. That was just purely luck on my part. But, unfortunately, the same luck is not available anymore, as you can see with 6%. And just to show you exactly what this can do to demand of housing, I built this little loan amortization table here. And you can see that, let's say you have a budget of $2,500 a month. That's your budget for making a mortgage payment. So, at 3.5%, mortgage rates, you can actually afford a home that would be listed at $510,000. I just have this ready to go here. You can see that the monthly mortgage payment would then be, $2,481, just under $2,500. But if I were to adjust this now to about 6.5%, mortgage, the same $510,000 house would now cost us $3,300 a month. So that would move beyond, your budget if you had a fixed, income, or if your job didn't suddenly, give you a huge raise. You would have to now mark down the price of the home that you can afford. And let's bring that down to $450,000. And that would still be beyond the $2,500 target. So if I brought it down to $400,000, that would finally be getting into that range here. So that would be, almost $390,000, $1,000 would get you to roughly $2,500 of a mortgage payment. So see what that does there? With just, an increase of 300 basis points of the interest rate, you go from being able to afford a $510,000 house to now just a $390,000 house, assuming the same, fixed monthly mortgage payment. So this is going to take a sledgehammer to, to housing prices here. And as you can see, the market has reacted. You can see that, the median price of the average, the median home sale price in the US has now come down. It soared, well beyond long-term trend growth to 21% year over year. That is unprecedented for housing. We haven't seen that since the 1970s. But that rate of change is coming down. And I believe that this number has a long way to go because, just for us to get back to trend growth, we need to see this number hang out in the negative region for some time in order to get the average or the median home sale price back to long-term trend growth, just to reverse out this crazy, 2 standard deviation move that we got. So all this is going to have a real effect on asset prices. When you see housing starting to crack, when you see, these high interest rates making it very, very unaffordable to buy a house and buy a car for that matter, this will take a toll on asset valuations overall. Now, here's the thing, though. This is what the Fed is looking at here. The unemployment rate, however, and this is probably the biggest source of good news right now that we do have. Unemployment rate is down to 3.4%, which is historically low. We haven't seen rates, the unemployment rate this low since the late 1960s. So this is tremendous here. Everyone who wants a job has a job. And at the same time, labor participation is up, by the way. So this is actually a real number. Usually, we can have a low unemployment rate if people just start, if people just quit looking for work, because then you don't get counted as being unemployed if you're not actually looking for a job. But, the labor participation has, trended up over the past year and a half. And yet we're seeing record low unemployment rate, which is great news for the labor market. That's what's keeping the consumer economy going. However, I think that this is what, the Fed and Jay Powell are looking at to, actually get a clear mandate to go further for longer on interest rates. So this is good news for the consumer, but bad news for anyone who is, dependent on low interest rates. So that would be the consumer economy that, needs, financing in order for it to generate revenue and sales growth. What this means is that because, unemployment is very, very low, I think that's going to be what the Fed looks at to justify increasing multiple times more. I think that, if we don't see inflation come down quicker, then, I think there's a real chance that we see, the Fed funds rate hit 6% by the end of this year. And therefore, also stay higher for longer too. So remember, it's not just the number of rate hikes, but it's also the length of time at which rates stay high. That those are both, factors that will weigh on markets and asset valuations. So with a low unemployment rate, I believe that the Fed has, or I believe that the Fed thinks it has a clear mandate to raise rates multiple additional times, as well as stay higher for longer. Here I have the Chicago PMI overlaid with the S&P earnings growth. And you can see Chicago PMI is a great, gauge of manufacturing activity. And this has a very high correlation to S&P earnings growth. And you can see that, the Chicago PMI is in deep, deep contraction, just like the new orders index from the ISM. And this is also kind of, showing us exactly why S&P earnings are coming down as well. Remember, this has a roughly 6-month lead time on S&P earnings growth. So as long as Chicago PMI remains in contraction, there is an increasing chance that S&P earnings, goes negative year on year. And that's exactly what my base case is that this number continues to remain in the doldrums. So, I think that there's a high chance that S&P earnings this year are down somewhere between, 0 and negative 5%. So I'm not calling for a deep recession like in 2008, a painful one, but I am thinking that we will be in a zero growth environment for the foreseeable future with, a negative earnings print year over year for 2023. And you can see that, analysts have taken note of that. You can see that they have marked down estimates and continue to mark down estimates even to today. Versus just, at the start of January, we can see that we're at $217 of S&P earnings. We're now below 216. And I think this number is going to keep marching lower until we get to about 205 to 210 ish in that range. So putting all this together, I think, with the markets at 18, 19 times forward earnings, we have 0% growth, 5% interest rates, likely going to 6%. The market is expensive. I just can't see why you would want to own the S&P 500 when there's, 0 to negative growth, when earnings are going higher, when all of the key economic gauges are, showing recession. And, when the Fed is very clearly telegraphing that they are tightening. I think that, with the market at 18, 19 times, that basically ranks in the upper third of observed, PE multiples in history. And so that to me tells me that a lot is priced in, at the price level that we're at right now. So, all this together tells me that, right now is not a great risk reward, opportunity for the market. Here, I just have a long-term chart, and this is kind of entering into technical analysis world here. But this is something that I think is worth, just watching and noting here. from a sort of technical risk management point of view, I have the S&P 500, charted here, and the 200-week moving average. So this is a very long-term chart, 200 weeks, not 200 days, but 200 weeks. And you can see here that, throughout, history, really over the last 60, 70 years, the 200-week moving average has served as a reasonably strong support level for the market. You can see sometimes it does briefly breach it, but then it recaptures it quite, quickly thereafter and never looks back. You can see that sometimes it stops right there at the 200-week, and that's the end of that bear market. You can see that happen here in late 2018. We, blew through it in the COVID crash, but then recovered it quite quickly. And here we actually tested it. We broke it very slightly at the October lows of 2022 and have since recovered. But here's the kicker though. Sometimes when this does break, it turns into a very, very nasty correction, as we saw in 2008, in 2001 to 2002, as well as back here in 1974. So this is something to keep an eye on for, risk management. When the 200-week moving average breaks down, it's time to go very aggressive defensively. Because when it does break, typically speaking, on a probabilistic, basis, history shows that things get a lot worse. So this is how I would monitor, the market. And, if this moving average breaks, it would be high time to, start going defensive. And so basically my takeaways here, again, 0 to slightly negative growth environment for the foreseeable future. The 5% Fed funds rate possibly going to 6% if inflation doesn't recede quicker. Jay Powell sees record low unemployment as a mandate to be aggressive for longer. I do think inflation is going to continue to cool off from current levels. We will see the Fed reach its 2% target, but not without an earnings recession. So S&P 500 earnings will likely decline year over year in 2023. So, I think that there is significant downside. I'm still kind of reiterating this until one of these things reverses course and invalidates my thesis here, until I start to see earnings rebound with, low unemployment, or if earnings rebounds, then this would get invalidated here. But as of right now, we don't see that happening. So my best target right now, given where we are, is 3150, and that's just assuming a garden variety earnings recession. That implies $210 of earnings per share for the S&P and a 15 multiple. Remember that chart that I showed just earlier? Analysts are at 200, let's just say 216 right now. So I'm assuming just 210 of earnings, which is not a big decline from where analysts are right now. But where the real kicker is a re-rating in valuation to 15 times versus today's 18 times. That would target 3150. That's a 20% decline, or slightly more from today's levels. So I think the risk remains to the downside. So how should we be positioned? I think that 1-year treasuries are a tremendous value right now. Now, even though the Fed may continue to hike rates, to 6%, I don't think it'll be too much more than 6%. So I will say that I think 6% or thereabouts will be the top of this rate hiking cycle, which means that if you buy a 1-year treasury bill today at 5.1%, and then buy another one when it's at 5.75%, that will be a tremendous income generating asset for the next year and a half. So I would combine that with the Zacks earning certain portfolio. Remember, the earning certain portfolio is a collection of recession resistant growth businesses. So, having a sort of a 2-asset portfolio of 1-year T-bills And the Zacks earning certain portfolio would provide a fantastic sort of 1-2 punch to be positioned in a low growth macro environment that we're, likely to be in for the next, 2 to maybe 3 years. So that's where I would be until otherwise noted. So these are the types of businesses that we own in the Zacks earning certain, portfolio. Just tremendous iconic companies that, have executed year in and year out, regardless of recession or boom cycle, regardless of high rates or low rates, regardless of strong dollar or weak dollar, regardless of high earnings growth or, high S&P earnings growth or low earnings growth. These are companies that are locked into long-term, contracts, as in the case of American Tower, or, moats that are, hard to replace, like Intercontinental Exchange, or even Global Payments, or companies that, produce, goods and services that are needed by by the masses, like Mettler Toledo, which makes precision instruments for labs, or Novo Nordisk, which is the global leader of insulin products, or Costco, which provides obviously critical needs for consumers, even Clorox. So again, these are the types of companies that we love to focus on, and you can see their earnings growth characteristics right here. Global Payments, regardless of what's happening, they continue to compound earnings year in and year out. Checkpoint Software, which is another one. This is a cybersecurity firm. This is a company that basically broke ground when they came out with their, firewall 1.0 way back in the early 2000s. That's what put them on the map, and ever since then, they have just a phenomenal business of recurring revenue, recurring sales. So just tremendous, execution over the years. And, as cybersecurity is in a secular bull market for the next 10 years, we believe Checkpoint Software is going to continue to execute well. And you can see this very, very consistent earnings stream, regardless of what's happening to the macroeconomy. Again, same with Mettler Toledo, one of the most, tremendously managed businesses on the planet, as you can see there in the chart of earnings growth. So these are the types of companies we love to buy and own. So regardless of your view of recession or not, I think the data is, pointing towards recession. So I would be positioned in these companies here, in addition to 1-year treasuries, which, I think are a tremendous value right now in terms of yield. So a combination of these two asset classes would provide you growth and income together. So you can use the income to then reinvest into some of these growth names, and be even better positioned going forward once those 1-year treasuries mature. And if that future rates are lower, then you can always then reallocate those cash flows into the earnings certain portfolio. So this would be a great 1-2 punch to be positioned in this environment right now. So hopefully you found that helpful. Again, love to hear from you guys if you have any questions or comments, or if you'd like a copy of the slide deck, we'd be happy to send that to you. You can send an email if you are a ZRS client to zrs@zacks.com, or if you are an Advisor Tools client, to send us an email to zat@zacks.com. All right, thanks everyone, and talk to you soon. Hope to see you again for the next one.